There is a version of the American dream that goes beyond just owning your own home. It is owning somebody else's home too, becoming a landlord, collecting rent checks every month while your tenant pays down your mortgage and your property appreciates, and you slowly build an empire of passive income that eventually replaces your day job entirely. You have seen this vision sold on YouTube channels and real estate podcasts and late-night infomercials for as long as any of us can remember. Buy rental properties, build passive income, achieve financial freedom. And here is the thing that separates this from a lot of other investment myths we have covered on this channel. The core of it is actually true. Rental real estate, done correctly over time, in the right markets, with the right financial structure, genuinely does build wealth. There are millions of people in this country who have achieved real financial independence through rental property ownership. It is not a scam. It is not a fantasy. It is a legitimate wealth-building path that has worked for a very long time for a very large number of people. But the version being sold to most people glosses over so much of what actually makes it work and what makes it fail, that the gap between the dream and the reality destroys a lot of people financially before they figure out the difference. So today, we are going to close that gap entirely. We are going to go through how rental property actually generates returns, the real numbers behind the cash flow story, the landlord responsibilities nobody puts in the highlight reel, the financing dynamics and how they have changed dramatically in the current rate environment, the markets where it works versus the markets where the math simply does not pencil, and the honest framework for whether this path makes sense for you specifically. Welcome to Better Investments. Let us start with the return model, because rental property has multiple return components working simultaneously, and understanding all of them is essential to evaluating any specific opportunity. The first component is cash flow. This is the monthly rent you collect, minus every single expense associated with the property. Mortgage payment, property taxes, insurance, maintenance and repairs, property management fees if you use a manager, vacancy allowance for the periods between tenants, and capital expenditure reserves for big-ticket items like roof replacement, HVAC systems, and appliances. What is left after all of that is your monthly cash flow. And for a lot of rental properties, in a lot of markets right now, that number is either very small or negative. We are going to come back to this in detail. The second component is mortgage paydown. Every month, your tenant's rent payment goes toward paying down your mortgage balance. You are building equity in the property, not with your own money, but with your tenant's rent. Over a 30-year mortgage, the entire loan gets paid off, and you own the property free and clear. On a $200,000 loan, that is $200,000 in equity that your tenants built for you over time. This is one of the genuinely compelling structural features of rental property ownership that does not exist in stocks or most other investments. The third component is appreciation. Over time, in markets with real demand, the property goes up in value. As we covered in our houses episode, the long-run real appreciation rate is more modest than most people assume, but the leverage amplifies it significantly. And in specific markets with strong population and job growth, the appreciation story can be quite compelling. The fourth component is tax advantages, and these are significant and underappreciated. The IRS allows you to depreciate residential rental properties over 27.5 years. What this means in practice is that even if your property is cash flow positive and appreciating in value, you can often show a paper loss on your taxes due to depreciation that offsets other income. You can deduct mortgage interest, property taxes, insurance, repairs, and management fees. For real estate professionals who qualify under IRS rules, the tax advantages are even more substantial. And the 1031 exchange allows you to sell a property and roll the proceeds into a new property without paying capital gains taxes, essentially deferring your tax bill indefinitely. When you add these four components together, cash flow plus mortgage paydown plus appreciation plus tax advantages, the total return on rental property can be genuinely excellent over long time horizons. The challenge is that these components do not all work equally in all markets at all times, and the one that gets the most attention, cash flow, is the one that is hardest to achieve in the current environment. Let us talk about the cash flow math, honestly, because this is where the fantasy and the reality diverge most dramatically. Take a typical scenario in a mid-tier market, a single-family home that rents for $2,000 a month. Sounds promising, right? Let us build out the full expense picture. If you bought that home for $280,000 with 20% down, you put $56,000 down and financed $224,000. At current interest rates around 7%, that is a principal and interest payment of roughly $1,490 a month. Property taxes on a $280,000 home might run $350 a month, depending on the state. Insurance, $150 a month. Property management, if you hire a manager, which most people who buy rental property eventually do, or should do from the start, typically runs 8 to 10% of collected rent, so call it $180 a month. Vacancy allowance, you should budget for the property being empty roughly 1 month per year, so divide your annual rent by 12 and set aside that $167 per month. Maintenance and capital expenditure reserve budget, 1% of the property value per year, which is $2,800 a year, or about $233 a month. Add those all up. 1,490 plus 350 plus 150 plus 180 plus 167 plus 233. You are at $2,570 a month in total expenses on a property that rents for $2,000 a month. That is negative $570 a month in cash flow. You are paying $570 out of pocket every month to own this rental property. Now, some people look at that and say, fine, I'm getting the mortgage paydown and the appreciation, so negative cash flow is acceptable. And in some markets with strong appreciation, that calculation makes sense. But negative cash flow means this investment costs you money every single month out of pocket. And if you hit an unexpected expense, a roof replacement, a major repair, an extended vacancy period, the negative cash flow accelerates and you need reserves to cover it. This scenario is genuinely common in high-cost coastal markets right now. The combination of elevated purchase prices and higher interest rates has made cash flow positive rental properties extremely difficult to find in many markets. This was not always the case. In 2012 and 2013, after the financial crisis, housing crash, when prices had fallen dramatically and before rates rose, investors who bought rental properties could achieve cap rates and cash-on-cash returns that were genuinely excellent. Many of the people you hear about building rental portfolios successfully bought in that window. The math was fundamentally different. The people who try to replicate those strategies in today's market without adjusting their approach for the current environment are the ones getting hurt. So, where does the math still work? The markets where rental property cash flow is most achievable right now tend to share specific characteristics. Relatively lower purchase prices compared to rental rates. Markets in the Midwest and Southeast specifically tend to look better on cash flow metrics than coastal markets. Cities like Indianapolis, Cleveland, Memphis, Birmingham, Little Rock, and similar markets have price-to-rent ratios that are far more favorable than New York, Los Angeles, Seattle, or Miami. Strong and diverse employment bases that support consistent tenant demand. You want landlords, not just any market where homes are cheap. Homes are cheap in some markets because nobody wants to live there and rental demand is thin. Population stability or growth rather than decline. A landlord in a shrinking Rust Belt city faces both falling rents and falling property values. Population growth markets offer better prospects on both dimensions. Landlord-friendly legal environments. This is something a lot of new investors overlook entirely. Some states and cities have extremely strong tenant protections that make it very difficult to evict non-paying tenants or that limit your ability to raise rents to market rates. California, Oregon, New York, and several major cities have rent control or heavy tenant protection regimes that meaningfully change the investment calculus. States like Texas, Florida, Georgia, Indiana, and Tennessee tend to have more landlord-friendly legal environments that reduce the risk of getting stuck with a non-paying tenant for months or years while the eviction process grinds through the courts. Now, let us talk about the landlord experience, because this is the part of the rental property conversation that gets almost completely glossed over in the financial freedom content. Being a landlord is a job. It is not a passive income stream in the way it is often described. It is an active management responsibility with real demands on your time, energy, and patience. Tenants call when the heat goes out at 11 p.m. on a Friday. Tenants damage properties. Tenants stop paying rent and then require you to navigate an eviction process that can take months and cost thousands of dollars in legal fees, during which time you receive no rent but continue paying your mortgage. Tenants move out and leave the property in a condition that requires significant work before the next tenant moves in. You will deal with maintenance emergencies, repairs that happen at the worst possible moments, contractors who do not show up or overcharge, and the constant administrative work of leases, insurance renewals, tax filings, and record keeping. None of this is unsurmountable. Millions of people manage it successfully. But going in thinking it is passive income and discovering it is actually a part-time job that demands immediate attention at inconvenient times is a shock that a lot of first-time landlords do not recover from emotionally or financially. Property management companies exist precisely to handle this operational burden, and for many investors, especially those who own properties in markets where they do not live, hiring a property manager is essential. A good property manager handles tenant screening, lease signing, maintenance coordination, rent collection, and eviction proceedings. They cost 8 to 10% of collected rent, but they can be the difference between a business that runs smoothly and a nightmare that consumes your life. The quality of property management varies enormously. Doing thorough due diligence on a property management company is as important as doing due diligence on the property itself. The single biggest variable in rental property success that gets the least attention is tenant quality. A great property with a bad tenant is a disaster. A mediocre property with a great tenant is manageable. Tenant screening, including credit checks, employment verification, income verification, rental history and references, is not optional and should never be skipped or shortcut, regardless of how urgently you want to fill a vacancy. Every month, a property sits vacant costs you money, but the cost of a bad tenant vastly exceeds the cost of a month of vacancy. The investors who build successful rental portfolios over time tend to be obsessively rigorous about tenant screening and completely unwilling to compromise their standards because a unit has been empty longer than they would like. Let us talk about financing, because the interest rate environment has changed the rental property calculation more dramatically than almost any other factor. When mortgage rates were at 3% in 2020 and 2021, the debt service on a rental property was low enough that cash flow positive deals could be found in a much wider range of markets. At 7% rates, the debt service on the same property roughly doubles compared to the 3% environment, and suddenly, deals that cash flowed comfortably are now deeply negative. This has a few implications for how to think about rental property right now. Paying cash for properties, if you have the capital, dramatically changes the cash flow math by eliminating the mortgage payment entirely. Many sophisticated investors who have built portfolios over time operate with significant amounts of paid-off properties or very low leverage for exactly this reason. Creative financing strategies like seller financing or subject-to deals, where you take over an existing low-rate mortgage, can sometimes access better rate structures than the current market offers. But these require sophistication and careful legal structuring. Buying in markets where the purchase price is low enough that even at current rates, the cash flow math works, requires genuinely low price points that are hard to find in primary markets, but do exist in secondary and tertiary markets. Being patient and waiting for the rate environment to change is a legitimate strategy if you are not ready to deploy capital at current rates. Rates historically do not stay at any given level indefinitely, and the entry point you buy at determines your returns for the life of that investment. Here is the framework for making honest decisions about rental properties. 1. Run the full cash flow analysis before you buy anything. Not the optimistic version, the realistic version with full management fees, full vacancy allowance, and full maintenance reserves. If the deal only works with optimistic assumptions, it does not work. 2. Know your market deeply before you invest in it. Not just the prices, but the rental demand, the tenant pool, the landlord-tenant legal environment, the property tax trajectory, and the economic drivers that support or undermine long-term rental demand. 3. Be honest about whether you want to be a landlord or just want rental income. If you want the income but not the operational reality, either hire a great property manager from day one and factor that cost into your analysis, or consider REITs and real estate crowdfunding as alternatives that give you real estate exposure without the landlord responsibilities. 4. Start with one property before building a portfolio. The learning curve in rental property management is real, and it is much better to make your learning curve mistakes on one property than on 5. One property teaches you everything you need to know about whether this is a business you want to scale. 5. Think long-term and buy with the intention to hold. Rental property returns are much better over 10 and 20-year hold periods than over 3 to 5 years, because the transaction costs of buying and selling are high, and the early years of a mortgage are heavily weighted toward interest rather than principal paydown. The investors who build real wealth through rental property are almost always the ones who buy and hold for a very long time. Here is the bottom line on rental houses. It is a real and legitimate wealth-building path. The combination of cash flow, mortgage paydown, appreciation, and tax advantages creates a genuinely compelling total return profile over long time horizons. The investors who win are the ones who understand the full cost of ownership, rigorously screen tenants, operate in markets where the numbers actually work, manage the properties professionally, and take a long-term perspective. The investors who struggle are the ones who underestimate the costs, overestimate the income, treat it as passive income when it is actually active management, and buy in markets where the cash flow math does not work, because they convince themselves the appreciation would make up for it. Do the math honestly, know your market, respect the operational demands, and if all of that still appeals to you after a clear-eyed look, then rental property has a genuine track record of building real wealth that is hard to argue with. Next time on Better Investments, we are going somewhere elegant and delicious. Wine, the asset class you drink. Is fine wine a legitimate investment with real returns? Or is it just a hobby with a financial justification attached to it? We are going to uncork the whole story, including the auction market, the storage requirements, the forgery problem, and whether Bordeaux futures belong anywhere near your portfolio. Subscribe so you do not miss it. And if this video gave you the honest picture of rental property that the passive income crowd never quite gets around to sharing, please share it with someone who needs to hear it. I will see you next time.